Hey, I'm back with Blaney White with Cross Country Mortgage. We're here to talk about lenders and why they do what they do when qualifying you for a loan.
Welcome to the Live Explore podcast. If you like what you hear, please hit like and subscribe.
I'm Alan Maceo, and this is the Live Better, Explore More podcast. Welcome, Blaney.
Thank you, Alan. Great to rejoin you.
All right, so tell me why do they, what the things that they do? Like, why gross income and not net income?
Great question. Gross income, because the assumption is that you're going to have more tax deductions with a mortgage and paying for housing expenses. So when we qualify a borrower, we use their gross income knowing full well they're going to be taking additional deductions on their taxes.
So how, like for a W-2, right, they can make adjustments going and say, okay, I'm claiming 0, now I'm going to claim 1 or 2 or 3 to help raise their net, right?
Sure.
But what about self-employed? I mean, how does that idea of gross versus net work for self-employed?
Well, self-employed is different because we do evaluate their income after their write-off. So we're looking, I mean, if it's a sole proprietor and they're filing a Schedule C, like CAT, on their tax returns, they're going to take their deductions first, and then we're going to use the gross income. But if you're talking about a W-2 employee using their salary, we're going to use the gross income, current gross income, to qualify them. But if they have variable income components in addition to their base salary, like a bonus, for instance, we're going to go back 2 years and average that bonus over 24 months to give them an additional bucket of income, but it's averaged. It's not current.
Does that also work for overtime?
Yes, it does, as long as when we do a written verification of employment, it's indicated by the employer that the overtime will continue, then yes, we would use overtime income.
Okay, if they don't verify, I mean, if the company doesn't verify, they'll continue, but there'll be some overtime. Do you kind of average that out?
We can average it out, but typically most underwriters and investors are more conservative on overtime because it's discretionary.
Yeah.
And even though there's a history of it, say for busier times, not necessarily predictive of future times for overtime.
Okay. So, and then this is something we talked a little bit about, and I had no idea. Well, impound accounts, right? For me, I always want the impound account because I don't have to worry about it. I just pay every month and you know, but financial people say, no, you shouldn't do that because now they're making float on your money. Put all that money in an account that earns interest. And then when your taxes come due, pay them. And, you know, when your insurance comes due, pay it, right?
Right.
But from the loan standpoint, there's a benefit to the impound account.
That's true. But you know, hey, should we back up and tell our listeners what an impound account is, Alan?
No, we don't want them to know anything. Just answer the questions. Okay, tell them what an impound account is.
Okay, so an impound account, another word for an impound account is a savings account that runs with your mortgage in perpetuity. So imagine that when you make your mortgage payment every month, you make a mortgage payment that's indicative of principal and interest on the loan. However, an impound account, or a savings account as it's referred to for mortgages, you're going to be depositing into that savings account each month 1/12 of your taxes and 1/12 of your insurance. So the reason you would do this, first of all, if you've got people who are on fixed incomes and they don't necessarily like to get a big tax bill, which in California we know property taxes are expensive, then it helps them to monitor and manage their expenses better by just depositing into that impound account / savings account 1/12 of their taxes and 1/12 of their insurance. So then that tax bill that you get in July from the county assessor, that would be considered a courtesy bill, and it will help you to calibrate with your lender so that when they balance the impound account, you'll know exactly how much is in there and if you have any overage. So it's basically a savings account for the express purpose of paying your property taxes and insurance.
Okay. So what happens if there's a discrepancy? Let's say you're paying more into it than you need, or paying less into it. When do those get settled?
Okay, so once a year. So there are some rules that govern impound accounts. The first one is that the impound account is supposed to have 2 months of padding. And what I mean by that is if your property taxes are $1,000 a month and your insurance is $75 a month, then it would have 2 months of padding of the $1,000 and 2 months of padding of the $7,500 or $75 a month for insurance. So that when the payments are made for taxes in November and April, they'll make the installment, which would be $6,000, but they'll have $2,000 left over. So that's a governing rule as an example for what impound accounts are required to do. The other governing rule they're required to do is to do an audit of everyone's accounts to make sure that there's no overage or under in the account of that 2 months of padding. If there's overage, even if it's $15 over, they're required to send all of it back.
The whole $15.
Oh no, all of the overage.
So the 2 month padding?
Yeah, they'll send it back. And this really trips borrowers up because they think, oh my gosh, I just got a windfall of payments. And I say, send it right back. They call me, hey, what's this check? Can we go buy a couch? No. Go send it right back, because they're going to ask for it back next month. They're going to say, now your account is short.
Oh, Jesus.
Would you like to pay it in a lump sum, or would you like to pay it monthly to catch up? So there's some tricks to managing impound accounts. That's one of them. If, for instance, your property taxes go up, which is pretty much the norm around here, if you get a bill and your property taxes are higher for the July through June fiscal year, then during the balancing, that escrow or impound account manager is going to communicate with you and say, hey, you are now $200 more expensive to your taxes. Would you like to pay that back over 12 months to catch up? Or would you like to deposit $200 into the account so that you're flush?
Okay.
So those are the typical ways that impounds are managed. But you brought up an interesting point, which is that a lot of people who have, they tend to get bonuses, or they get restricted stock units, or some other large lump sums of income as a component of their regular income. They tend to want to pay their taxes directly, which makes sense.
Right.
But I would say for the average homeowner that's in a conforming loan and they're just standard W-2 employees, they'll find it more comfortable to use an impound account.
But there's also another benefit to it other than making it easy.
Yes, there is.
I mean, like I said earlier, if you do well managing your money, and you can keep that tax money, that insurance money in an account, get the interest, and you're diligent about paying them when they're supposed to. Mm-hmm. But there's something else. So the loan rate, right? And I'm making this number up. And I'm not looking for an exact number. I'm sure it moves all over. But let's say the mortgage note is 6 1/4.
Okay.
And now, but I'm gonna do the impound accounts. What type of change does that make, or does it?
Okay.
Or what's the benefit to me other than the 1/12 peace of mind?
Great. Okay. So can we back up again and explain why lenders like impounds?
You like the camera in the car, don't you? So when you back up, you don't worry about hitting Grant or anybody else.
I just like the sound it makes.
That's right.
So here's the long answer. There's only one entity that can take ownership of a property if a homeowner defaults on paying their mortgage and paying their insurance and paying their property taxes. And one would assume it's the lender that holds the note on the property, but the truth is it's state and local government. So if, as a homeowner, you haven't paid your property taxes for 6 to 12 months, the lender's going to jump in and pay it for you so that they have first right to own the property. That is why lenders incentivize borrowers to go with an impound account, because they're assured that they always have the money to keep you current on your taxes and your insurance. So they'll give you about 1/8 of a point better to rate if you go with impounds.
Okay. So in the example, a 6 1/4, so it would drop down to now it'd be 6 1/8.
Yeah,
Okay. But that's something,
it is something.
right? And over the term of a loan, that could add up,
Yep.
right?
Yep. So now that you understand impounds, the question is, are you going to do it or not do it? The answer is, are you disciplined in your money habits or not?
Right. And that's really the bottom line.
Yeah.
The 1/8 of a point sounds good, and it sounds small, but over the life of a loan, it adds up.
Sure.
But if you're not disciplined, it won't matter.
It won't matter.
You'll be in trouble soon.
That's right. And we would rather have the roof and the doors
Exactly.
than 1/8 of a point.
Exactly.
Yeah.
All right. Reserves, right? Everybody talks about how you got to have a certain amount of reserves for the loan. And so the question is, one, what's reserves? Two, is it the same reserves? Is it the same for every loan, or does it move? And if it does move, what makes it move?
Okay.
So what's reserves?
I didn't know reserves moved, but I do know that you have to have reserves. And excuse me, I need a sip of water because Kermit the Frog just jumped in my throat.
You can't make that up anywhere.
No, you can't. So reserves are basically, say you are crossing the street and you get hit by a semi and you can't work for a while. That's when reserves would come into play. The lender, when they qualify you for a mortgage, they're assuming you have a normal stream of income. But everybody knows that life events happen, right? You can get hit by a car. You could fall off your bike. You could, eat some bad food and be
Be down for a while.
a really long while. God only knows. So that's when you would start using your reserves to make those payments.
Okay.
All right. So Fannie, Freddie, FHA, VA, they don't require reserves.
They don't.
They don't. As long as your loan amount is under the national conforming limit of 726.
Okay.
When you get into the agency high balance category, which is defined by by county as a high cost living area, there can be, depending on loan amount and loan to value, some requirements for reserves, although typically, again, not required. When you get into the jumbo loans, the non-conforming loans, those investors expect you to have reserves. And typically they're looking for, if you have a retirement account and it has $1 million in it, you could use 600,000 of that to qualify for the reserve requirement of your loan. And the reason why they would require you to only use 60% of it is because the assumption is most people would have some sort of tax event by withdrawing their money from their retirement account.
So do they, in that example, the 60%, the 600,000, do you have to lock that money up?
Nope.
So that just sits there in the account and nobody messes with it.
Right.
Right. And so it's not like you got to take out the 60% and stick it in their bank.
No.
Okay.
And don't fall for that, consumers. Mm-mm.
Okay. What do you mean by that?
Listen.
We're getting off the reserves, but that's a point.
We are and we aren't. So listen, there are things out there, loss leader loans, where banks will offer you an incentive on your interest rate if you deposit $250,000 into their bank, but you can't withdraw it. You have to have it there as a reserve requirement. I'm sorry, that's letting go of control of your own financial destiny. If you've got an investment advisor, say they're at Fidelity, and your money's doing great there and you have a great relationship with your investment advisor, don't move your money. All you have to do is demonstrate that it exists. And then we would need to, in the loan file, collect the rules for withdrawal. They're called terms of withdrawal. And
Okay.
it's pretty much the same for everyone. If you are not of retirement age and you go to withdraw the money from a retirement account, you fill out a form and it asks you if you're going to have the taxes withheld then or if you'll pay for that tax event later.
Okay. So let's jump back to reserves. So only the one loan requires reserves. Is that right? The non-conforming.
Agency typically does not.
Okay.
Agency high balance by category or by high cost county typically does not. If you've got something that's really high loan to value or low down payment, it could potentially require reserves in the jumbo agency high balance category. Always in the jumbo category, so anything north of 1.089 million is going to require some form of reserves.
Okay.
Typically 6 months. As you get larger loan amounts, it could be 12, 18, 24 months of reserves. And now you're going to ask, how do we figure out what that is? Aren't you?
Sure. Go ahead.
Okay. So the way that we figure out how much you need in your account is based on the principal, interest, tax, insurance payment each month on the property. So if it's $1,000 a month, wow, that would be a crazy affordable place. But if it was $1,000 and you needed 6 months reserves, you'd have $6,000 available in that account.
Okay. So it's just 6 times whatever your monthly PITI.
PITI,
Great.
yes. But jumbo loans, larger loan amounts, I've seen them as high as 36 months of reserves.
Wow.
So if you have a $10,000 a month commitment, you're talking about $360,000 in reserves. So gotta know before you go.
Okay. Perfect. All right. Down payment's always the other real fun one. Because nobody wants to pay 20%, but nobody wants to pay 3% or 3.5% because there's an issue with that.
Yes.
So tell us the difference. What happens like below 20%?
Okay.
Okay. And then leading up to 20%. And maybe explain why 20% seems to be this magic number or percentage.
Okay. Well, it's not defined by me. Guidelines for percentages of down payment really tie back to a concept called loan level pricing adjustments, or LLPAs, loan level pricing adjustments. So the investors behind the loans that consumers get, they have certain appetite for risk layers or not risk layers. So I'll give you an example of risk layers. Investment property versus owner occupied. That's considered a risk layer to do an investment property loan. So automatically they're going to have a higher requirement of down payment for a non-owner occupied property. So that would be considered one risk layer. A single family residence is highest best use in real estate. So that's a low risk. Say that fast 10 times.
Exactly.
Oh my goodness. What is the matter with me today?
You need another drink of water?
Listen, I need the listeners to know that this man did not have any milk for coffee today, which is why I sound like this. So, yes, risk layers. So when you talk about percentages of down payment, that indicates a higher risk or lower risk, depending on how much skin in the game or money down the buyer has. The more down, the lower the risk for the investor, because it's shared risk. The assumption is that as you buy a home, if you're putting 25 or 30% down, you've got a vested interest to hold on to that property.
Right. Not let it go to foreclosure. Right.
That's right.
Okay.
That's right.
And is it the second home? Because if you're going to let something go, you're going to let that go before you let your primary residence go.
True. Second homes, although second homes are typically priced a little bit better than investment properties, they're still considered auxiliary to your primary residence. So yeah, it's going to have a little bit of a bump to it for second home in jumbo space.
Okay. So, but there are always people out there who just have enough to get in, right? And we as the real estate community say, get in.
Yes.
Just get in however you can get in, right? And then let the market drive up the value of your property. And then so when you move on You're using other people's money to move on. But there's mortgage insurance, right? When you're down below 20%.
Yes.
Okay. So anything under 20% is mortgage insurance.
Yes.
And tell us about that.
So mortgage insurance benefits the investor, not the consumer. So I think it's important for you as a consumer to understand that there's no shame in using mortgage insurance. It's a great tool. It's a really great tool. There's 2 ways to buy a house with 10% down. One is doing one loan at 90% with mortgage insurance, which if you default, there's insurance that guarantees the investor that they're repaid up to a certain threshold of their investment. Or you could do an 80% first, there's that magic percentage again, plus a 10% second, and you could do 10% down and avoid mortgage insurance. However, I would tell you in this market of rising rates and the Fed being, breaking the system right now with rising rates, you're better off going with mortgage insurance than you are going with a home equity line of credit to avoid mortgage insurance.
Is the 80-10-10, that second loan, is that what you call a equity line?
Yeah. Yep. And
So it's like a HELOC.
It's a HELOC.
Oh,
So that's all it is.
Yeah.
And 100% of, so say you've got a $300,000 first mortgage and you've got a $40,000 second mortgage. The second mortgage $40,000 funds essentially are the other half of your down payment.
Right.
But it's in the form of a loan.
Right.
Yeah.
Okay.
But in this market, is that a good choice? Probably not if you're a first-time buyer.
What's a HELOC loan go? I mean, mortgage rates right now are in the 6s, right? Oh, somewhere.
They're higher than that.
7s?
Yeah.
Okay. So a HELOC's got to be about 2 points above that.
Well,
3
a
points?
HELOC is 2 points above prime.
Okay. So
Prime
how prime
is-
is prime?
Prime is very prime right now. It's in the 8s.
So you
So
got a
you're
double
talking
digit.
about a HELOC somewhere in the 10s. And remember that a HELOC, because it's variable, it's got a floor and a ceiling in terms of interest rates. The floor is probably set somewhere around 4%, and the ceiling typically is 18%. So why would a first-time home buyer go for that option? Well, they probably shouldn't.
Right. They got talked into that.
I think it's better to go with mortgage insurance in that event.
Okay.
And by the way, FHA is a cool option. If you're a first-time home buyer and you want to have little down payment, but say you want to buy a 2 to 4 unit building, you can use the other 2 units in that building, the rent, to help you qualify to buy that building.
So, but that's the presumption that the other 3 units are in the 2 to 4. The other units, right, are currently rented.
Yeah.
Okay.
And you know what? It's a cool option. I've had lots of buyers, especially over in the East Bay. There seems to be a pretty good selection of 2 to 4 unit buildings. I've had a lot of first-time home buyers buy on FHA with 3.5% down. They bought a building and the other units helped offset their rent and expenses. Yes, there's mortgage insurance involved, but it's a great way to start earning equity and get your toehold in the real estate market.
That's fantastic.
Yeah.
Okay, so that's the down payment scenario, and that was great. The looking at multi units,
Yes.
because that's not most people, first time buyers. Their thought process isn't down the road that far. It is like, just get me 1 unit. You know, that 2 and 3, I don't know what I'm gonna do with that. So that's brilliant to look at that.
It's been over the years, and I've been doing this a couple of decades now, over the years, it's been a really popular option for first-time home buyers. So if you have the option to get a 2 or 3 unit building, by all means do it. You occupy one, you get rent income on the others.
Right.
The cool thing about having a multi-unit building is that the chances of all 3 of them being vacant at the same time are very small likelihood. So you've always got rent coming in. And over time, if you want to move out and keep that building as an investment property and vacate the unit that you're living in, now you've got an investment property and you're well on your way to starting to build a real estate portfolio.
Nice.
And we all know that real estate is a really great way to build wealth, don't we, Alan?
Yes, we do.
Yes.
I got notes here that say I need to answer that question that way. Okay, loan thresholds. Okay, what is that, and why do they vary by county?
Okay. Well, I have to squirm for a second. Loan thresholds. So nationwide, Fannie Mae, Freddie Mac, those are, does everyone know, do our listeners know who Fannie Mae and Freddie Mac are?
Aren't they your aunt and uncle?
Oh, no.
Okay, tell them.
Okay, Fannie Mae, Freddie Mac are lending institutions. They are not, I need to say this clearly, they're not owned by the government, even though there's that fallacy out there. Fannie Mae, Freddie Mac are institutions that loan on mortgages. Okay? Fannie Mae owns 80% of the mortgages in the conforming space in the United States. So they've got a very large footprint. And typically those loans are up to the threshold that are established by Fannie and Freddie every December. And so right now, it's $726,000 for anything conforming. So anything below $726 to, I don't know, $10,000, most people wouldn't have a mortgage for that small, but down to zero. Those loans have the easiest guidelines to qualify for.
Okay.
Easy. So, and in times when the economy's having a hard time, it's what the Federal Reserve will influence. It's what Fannie they'll change their guidelines to make it so that you can have a drive-by appraisal to lower your interest rate. You don't need an appraisal to lower your interest rate. They will control economies by offering lower interest rates, which helps the greater good. So Fannie Freddie conforming loan limit is 726 right now. Anything above that by county can also be in the agency Fannie Freddie lending space, but by county there's something else that is an established high cost living area. So Sonoma County's in the mid 800s, Marin County is $1,089,000. So by county, they're going to establish what they think the maximum loan amount should be to meet the easiest guidelines available.
Based on what the income is of that county?
Based on the income, the housing cost.
Okay.
There's all sorts of factors that go into how they come up with that number, although they're very weird numbers, like 726,200 and 861,350. But these are the numbers they establish once a year. And then all the lenders work against those guidelines.
Okay, you mentioned something about, to make it easy, doing a drive-by appraisal or not even doing an appraisal. In today's market, are they still doing no appraisal or
sometimes
drive-by?
Sometimes.
What triggers that? Because right now that seems, I don't know. I don't know that the market seems right for that type of, if they're going to lighten up something, that didn't seem like something they would lighten up.
It's typically something that's offered when the value of the homes are stable. Think of yourself like trying to go to Willy Wonka's. You know how Charlie gets the chocolate bar and he has to open how many to get the golden ticket?
Yeah.
That's how I think about appraisal waivers. They're called property inspection waivers, and it comes when you run the automated underwriting software for Fannie and Freddie.
And so it'll decide that software will decide, hey, we don't need an appraisal, or just have somebody drive by.
Yes.
Okay.
Yeah.
But that's hard to, it's hard to define what really triggers that, right?
Yeah. But, in addition to that being a lenient guideline, there's also income documentation guidelines that are more lenient. There's, the factor of not having to have reserves to qualify for a mortgage. That's more lenient. So those would be the main buckets the property value, the income amount, your down payment. You could get gift funds. That's very helpful for a lot of first-time buyers. So Fannie Freddie guidelines.
Gift funds.
Gift funds is a next of kin gives you money towards your down payment, and they state where we prove where it comes from. They state that it's not a loan and does not need to be repaid. And that money would go directly into escrow towards your down payment.
Is there a limit on that money? How much, so if you were trying to buy a home for $700,000, right? And you were going to you had the 10%. So can they put $100,000 in on the gift money? Is there a limit on how much gift money you can get?
Not on jumbo, yes. Most of the jumbo products define that you must have 5% of your own funds plus closing costs. Not true for Fannie Freddie.
Okay, so if I have a rich uncle next to kin who says, here's $200,000 on your $700,000 purchase, that's okay.
Yep.
As long as I have do I have to have some money in this thing? Or can I just call my rich uncle and he's going to throw $200,000 at me and I put that in and that's my down payment and closing costs and everything?
Yeah.
Wow. Okay.
Right.
I got to start making phone calls to my uncles.
Did you know that there's a Fannie Mae program out there for parents sending their children off to college?
No.
Yes.
I'm going to find out, though. Go ahead. Tell me.
I'm going to tell you. You know they can buy a place for their kids to live?
So your kid goes off to college in some other area. You buy a home in that area instead of sending them to the dorm. Okay. So go on.
And so the guidelines are pretty lenient for that because typically, we talked about loan level pricing adjustments, right? Risk layers. It would be considered owner occupied.
Wow. And then they know they're going to rent out the other rooms, right?
Well, it doesn't matter because we're not using that income to qualify.
Oh.
Yeah.
I didn't know that.
Right.
There you go. So
all right. So parents out there listening to us, instead of paying for exorbitant dorm fees, how about call Alan and he'll help you get a place for your student going off to college to Sonoma State. Right?
Yep.
There you go.
That would even be better than paying on an apartment.
That's totally true.
Right.
Yep.
Okay. That's great. I didn't know that. That's why I had to ask us.
Pretty cool stuff.
Okay. So that you kind of give us the why. And I think it helps people like, the Impound account. I thought that was brilliant. I had no idea. And I've been on the buying, selling side, right? And mostly it's the buying side that you get that to worry about. But nobody's ever said that to me. Nobody has ever told me, hey, use Impound accounts and we can do something, right? There's an incentive for it. Nobody's ever said that to me. That's one. To the down payment thing, it's always been kind of a mystery, right? Everybody strives for 20%, but then the reality is you just try to get in the game with whatever it takes.
Yep.
Right? Threshold was never, never heard that. Right?
Yeah.
I know of it, but I didn't know the parameters to it. Right? And I think that's a big deal. The gross versus the net, that was another good one. Right? Because a lot of people don't know that, you can claim more, right? To offset the tax liability on a check.
Right.
To pay your mortgage because then you're just going to, deduct out.
That's right.
Okay.
And by the way, Alan, shame on your lenders for not explaining to you what these things were because they didn't leave you a very informed consumer. You know what that means? That means next time you need to dial 415-509-7788.
That's brilliant. Listen, that's a segue. I just laid that. That's low-hanging fruit.
Well,
There you go. Listen, Blaney, thank you very much.
Thank you, Alan.
I thought this was very informative. I think first-time home buyers, right, or newbies to the world of real estate, this will really, I wasn't a newbie and I didn't know a lot of this. So I think this is very informative. Thank you for being on.
It's my pleasure, Alan. Thanks for having me back out.
All righty.
All right.